Hi, this is Randy Finney with the Right Side of the Chart, and this is a mid-session update for Wednesday, September 3rd, 2025. It is 2 o'clock p.m. on the button as I'm starting the video, and here's what we'll do. I'm going to take a look, as I like to do, start out with the equity markets, brief update there. Nothing big so far today. Flattish day to be expected. The rest of the week, we have the economic events that if they're going to move the market, those are the ones that are probably going to do it. I'll get to that in 1 second. We'll look at the economic calendar. Just to kind of recap. This is, we've had two reactions off that. It's a very good, in my opinion, even better now, obviously. I wouldn't have listed it as the first price target if I didn't think it was a significant level. Remember, we first shorted here, then I re-highlighted it on the bounce back to that downtrend line there. Maintained the trade all along with a stop above on a daily close above 580, and then gave you this shorting zone recently, which we're still in right now. So there's really no update. Again, markets are flat-ish. You can see here QQQ's up about 1/3%. SPY is flat, virtually flat right now, and the small caps are slightly down. Again, it's all, in my opinion, about the economic calendar this week. I'll get to that in 1 second. So not a lot to update, but just to reiterate, if and when T1 breaks, as I expect, that's still why I maintain these targets. It's going to increase the odds we come on down to the next target, which is T2. And then if and when that one goes, that should significantly increase the odds that these deeper targets get hit. And then that does something to the longer term charts. Then I'll turn my focus to the daily and weekly charts because we're most likely going to have some technical damage done there. And that's going to increase the odds of those much deeper swing/trend targets. This is just a typical swing trade with a holding period measured in days to weeks. And then I still maintain those longer term downside swing and trend targets. We just need there's some work that has to be done technically in the charts, and that is, take out some key support levels, take out some, trend lines, or I should say more so key moving averages, things like that. So anyway, we'll update you there if and as if this plays out. One thing I wanted to get to is the economic calendar and talk a little bit about that. Remember, on right side of the chart, you can access the economic calendar by going up here to the top of the page there, clicking on resources, which I'll do now, and then that brings you in tools of the trade. I use this all the time myself right here, and you have the earnings calendar right there, economic calendar, whatever you want to get to. And so today we had two potential market moving reports. These are a little bit, for lack of a better word, dated. Let me color this up red. They don't have jolts and factor orders. They have as green little diamonds. The red stars being the potentially biggest market moving reports. This is, again, I've been using this, this economic calendar for many years. They just haven't changed anything. Right now, it's all about jobs market. Jobs are very important. Jolts isn't, again, it's not the biggest market mover, but it is worth monitoring. Tomorrow, you're going to have jobless claims and ADP employment report. As I mentioned, this is shifting from a green star to a red star because, and I've read about this, if you've been following, the government data now is becoming less reliable. We're becoming more like China with manipulated data, with Trump trying to, fire if he doesn't like the numbers from an agency. He'll fire the head, put somebody in that's going to give him good numbers he wants. And again, that it makes it a little more obscure. The numbers a little less trustworthy. And so as I read, more and more economists and, fund managers are leaning on ADP. And so we'll see, again, what that does to the market tomorrow. So under factory orders today, you can see there, the consensus was for a drop of 1.4, came in at 1.3. Nothing big, but trending lower. And then you had the JOLTS report come in at actual, the consensus was for openings of 7.375, so almost 7.4 million. Came in under 7.2 right there. For some reason, I don't know why they do it when they don't give you the chart they give it to you on the web app. It's a great app for your mobile phone. Oh no, this is Econoday. I'm sorry. I use the investing.com, but let me show you. So here's investing.com where you can actually see those numbers, and right here. So here's JOLTS right here, U.S. job openings. It gives you a description, and you can see the trend. I mean, you don't have to be an expert market technician to see where things are trending here. Let me grab an arrow tool and just show you that it peaked here, and we're clearly trending lower. And again, it's just a trend. We know that the job market's slowing. The economy will ultimately follow the job market. That's just an immutable fact in the economy. Consumer spending accounts for 2/3 of GDP. Therefore, when people have jobs, everyone has jobs. People are flush. They're spending money, and when they don't, it goes the other way. So it's not. It's more about the trend than the actual level. But again, you can see the trend clearly going lower there. So let's move on. And again, just keep an eye on the upcoming reports. There's a lot of stuff coming out up until 10 p.m. tomorrow, from about 8:15 to 10 p.m. You even have the Challenger job cut report, 7:30 in the morning, and then the employment situation to end the week there Friday. So that's what our economic calendar looks like. Those are the things to watch. Job market right now is everything. There's that balancing act the Fed is doing between inflation and the jobs market. So they have to balance that, and they get too easy. They're worried about inflation getting out of control, and if they keep rates too tight and too restrictive, they're worried about the job market going down. So market's watching all this stuff right now. And so back to the charts. That's it. QQQ. I gave you yesterday a bounce target zone, which I believe is an objective short entry area. We've had we hit the first target 2 times yesterday, bounced both times. We went up, we made that gap backfill. Market doesn't like to, sometimes it'll do it, but it doesn't like to leave unfulfilled gaps. So we have that check mark, and so no unfinished business now. Again, T1, if I thought it was support when we first shorted the Qs, remember this is an official trade. Those are the ones I have the higher degree of confidence on. Although not to say, sometimes 90% of trade ideas on this site are given in these videos, because I'll cover sectors, I can cover 20, 30 stocks in a video. That would just take hours and hours and hours of work to put up individual charts, annotation, and you'd have to go through all that stuff. So I think the videos are more efficient to cover a lot of trade ideas. I always will express my convictions on a trade. And again, very, very important. If you're new to the site, there's 2 types of trade ideas that I share. A trade setup. This isn't really a drawing tool, it's a line tool. A trade setup, which is an untriggered trade waiting for an objective buy or sell point. If it's a short, it's a sell point. And that would be something, on a bearish or bullish chart pattern. Let's say you have a head and shoulders pattern. You want to wait for the neckline to break. That might be your entry in that one, or a bullish or bearish rising or falling wedge. That's a trade setup. If it never triggers, it was never a trade. I never took it. You never took it. Those are it's not an actionable trade idea. Whereas the other types are what I call actionable trades. Maybe it just broke out, or already broke out, or for example, in QQQ, first highlighted it here on a back test to that downtrend line, then again on the second back test, maintained that as long as we're below that stop, I still like the trade, and then gave you these add-on points here, and so this is an actionable trade, but the objective entries are, for example, in the last couple of days, twofold. What you absolutely don't do is short when you hit a target, because you're hitting support. If anything, you cover the short and or go long to play a bounce. That's TA 101, technical analysis or trading 101. You buy support or you sell a break of support. The other thing, when you're in a short trade, it's just like being on a long trade in reverse. You will short rallies into resistance. And so that's what you have there. So that was an objective entry today on the gap backfill. And the next objective entry after that, the most objective that I can see right now, would be a break of T1, especially especially the fact that if I thought it was support for the reasons stated before when we first shorted here, the fact that we've had two more nice reactions off that level absolutely validates that as a significant support level that traders are watching and trading off of. And it tells me that if it breaks, there are no guarantees, but odds are there's going to be a lot of stops on long side traders below that level, and you probably have more shorts pile in. And so that's how it works. T2 is the next target. If and when that breaks, as I said, it's going to increase the odds of these deeper targets being hit. If that happens, if we go down and start going down, especially towards T5, it has the potential to trigger some more powerful sell signals, support breaks, maybe trendline breaks on the more significant daily and weekly charts. Significant in the form of a long-term swing or trend trade. Okay, so I've already given you those targets. I don't want to get off topic too much. I cover that the daily and weekly charts. I just covered them this week. I just wanted to kind of update where we're at. And again, we're probably not going to do much today. We've got a lot of economic reports coming out in the next couple of days here, so I don't expect fireworks. You have the levels, take them, trade them, up to you. All right, I'm going to do in this video, I wanted to cover, somebody asked, I was out this morning, went out to do a few things, and I did see, oh, we have a new comment here, I'll get to that. There's one yesterday that I didn't see, it must have been posted late yesterday. I already replied to these other ones. You could take a look there. My VIX chart, which is interesting too. This is the weekly chart of VIX. Again, I posted that yesterday. And it just shows on the weekly chart, we've had 1, 2, 3, 4, 5, 6 big divergent lows. And this goes back to the 90s, all right? And this is where previous bear markets end. And then since the 90s, since the financial crisis, this is where the two big ones, the financial crisis and COVID. Obviously, those were the two biggest and only times there was real panic. And you can say what you want about Trump's liquidation day, but the VIX certainly didn't respond like it did back then. But it hit this, this is a level where corrections have ended. And I've noted this for years. I've had these, and I just updated that to say really up to 2009 to 2025. It's where bull markets end. Here, I'll show you. So the VIX still looks to me poised to pop. We're coming off that. See, it's been updated to show you that's where all the corrections have ended, but not bear markets. So once we get the longer term sell signals triggered on the weekly and monthly time frames, at minimum, this is most likely where the VIX will be going. And again, to try to put it in perspective from where we're at today, roughly, about 412%. And so when you go down to a shorter term time frame, the VIX has been moving up lately, as I covered the other day. There's that little breakout recently. So let me go back to that post from yesterday. Somebody asked right here, please provide your views on feeder cattle and UPS. Okay, we'll do that right now for you. Okay, I threw out feeder cattle and live cattle to you last week as a couple of my favorite shorts in the commodities arena. Natural gas, my top pick as far as profit potential. It has more upside potential in the near term than I believe than the other ones I like, wheat, corn, soybeans. But on the short side, these guys have just gone parabolic. And there's going to be a ceiling. It's not a hard ceiling, but a soft ceiling where, meat prices can only go up so much before your steak lovers start buying pork chops and chicken or whatever else, and friggin' Whataburger, tofu, something along those lines. And so this is just the near term. So yeah, we're coming off that divergent high. We had the sell signals I mentioned last week, I think it was, and still an objective short entry. And once it takes out this trend line, once it hits and breaks T1, I plan to add to the position. Told you I took a starter last week on the initial breakdown, but it looks very toppy, big divergences. This is just a 6-month, 2-hour chart. Let me try to show you what it looks like. Here, let me grab a chart longer term. Let's go back to that investing.com. We'll type in GF here. GF, or oh no, it doesn't pull up that way. On the feeder cattle, there we go. FC, I'm sorry, what was I on? GF, okay, this is FC. Sorry, FC, go back to do a 1 year chart, just to kind of give an eye. You know what, I haven't logged in. Am I logged in? No, not into the main account here. Technical chart. Sorry guys, I should have had that queued up for you. 1 day. Okay, I think I have it queued up. Okay, so this is my GF. That's the ticker used on this platform and trade them. And then what was that? I was just using investing.com. They do FC. Same thing. They're feeder cattle. You can see where they've just gone crazy. I'm scrolling back here. 2021. If you go back for years, here's where beef prices were, or at least feeder cattle, I should say. It's different. We were in this basing pattern. We broke out here. Welcome to the new world inflation. Tell me this isn't trickling in, doesn't hit the consumer. Sure, it's not as big as oil or housing. Those are some of your bigger components. But it's one thing after the other going up lately, and you can see again. So yes, so the bottom line is I still very much like it. Nothing's changed. You have this is a parabolic uptrend line. I'm using a log scaling, and this is not linear arithmetic. So we've gone parabolic. Parabolic trends never end well. And ultimately, I think we'll come back in at minimum right here to that about about 265. That's what I'm looking for once this thing breaks. What would that be in percentage terms? Where's my, I don't use this one all the time. Measure, shift click, go down and drop there. What is that? Let's try it one more time. See if I'm doing this right. Okay, we'll try it one more time. Click here, click on where we're at right now. Taken down to that level, it's going to be about a 27% drop in feeder cattle. So there's that. What was the other one? Was it UPS? Go back to where we were. UPS, okay. UPS. We hit it once on the way down. This is a stock, again, used to be one of the canaries in the coal mine, if you will, for the economy, UPS and FedEx. Sure, you know, things, a lot of the old indicators, we used to have copper. They used to call it Dr. Copper because it had a PhD predicting the economy. That kind of got stripped of its doctorate. And then you have things like UPS and FedEx. Well, you know, left alone, this would be extremely bearish for the economy. But they've been dropping for a while, and a lot of that is because they lost a lot of business to Amazon when Amazon started doing their own deliveries. So all I can tell you, a divergent low. It's in a bear market. When I look at it here, okay, there it is. My weekly chart. I'm just doing this live. I didn't have a chance to look at it before. Yeah, I like it. These are levels I've had here for a while. Let's see. No, created that back. Yeah, earlier this year, in May. Nice support. So there it is. Long story short, you have some positive divergence there. You're starting to form on the PPO. Certainly been building on the RSI at support. If the market doesn't crap out completely, this would be one of my top picks. I like it here. Again, you're at long-term support. You're in a bear trend, so certainly time, in my opinion, especially if you're a longer-term bullish on the market. Now, keep in mind, stocks like UPS is going to be indexed in a lot of big indexes, most likely. So you're going to have that indexing effect where, just like they say, all ships are lifted in a rising tide, meaning in a bull market, the inverse happens in a bear market. So keep that in mind. And again, nothing wrong, especially if you're shorting. Let's say you took the QQQ short, you're in that, or the SOX short, or something like that. And I've told you many times over recently in the past couple of months, my preference is to go long blue chip stocks. This is still a blue chip stocks, proven brand name stocks. That are at support. Almost all of those. We hit Pepsi at the lows. Now you're hearing that, who is it, Elliott Capital or somebody's trying to, do pressure the board, big turnaround. But the charts told us to buy Pepsi right here. We picked it right at the bottom. We milked it up here. And these are the kind of stocks over and over lately that I've been sharing. And so, yes, to answer the question, there it is. And on stops on UPS, again, if you're picking a bottom or at least trading a bear market rally, I love bear markets, not just because I like shorting stocks, because I love trading bear market rallies. Nothing is more explosive and powerful. You make twice the money, 5 times the money in a bear market, both on the downside, shorting, because stocks fall a lot faster than they rise in a bull market. And the bear market rallies are explosive because they're not just bargain hunters stepping in and buying. You have short covering. So you have that explosive mix and you make a lot more money. So there it is. Targets, say, come up here to about 103.50 up to about that 108 level right there. And then maybe certainly every stock, even a bear market, is going to come and check its 200-day moving averages every now and then. So what does that give you? Roughly, I'd say right now about a 25% upside or so on UPS from here. And again, now if the market shits the bed tomorrow or this week or soon, and again, I'm seeing a lot in the charts. That's why I'm doing these videos. They're long-winded, I know that. I'm going to dive into the charts now and show you some of the things I'm watching. I've already covered SPY and QQQ quite a bit. Let me just make sure. I saw one more comment that was posted since I checked earlier, right before I started the video. So let me see if it's a question or a chart request, and I'll get to that. Just an observation. Wow, gold continues to go higher. Yep, gold's making that pop above the trading range, as I said it would if it did, and it's likely is a divergent high. And again, divergence is not a sell signal, so let me go to a weekly chart here. You can see it here. It's not a sell signal, it's a condition. So, but you have big divergences building on both the daily, and this is my weekly chart, weekly time frame. And as I've said many times, again, this is just from my experience, years and years, decades of experience. Breakouts that occur on overbought conditions with negative divergence have a much higher failure rate than those that don't. So you don't have any sell signals. One of the first sell signals would be a drop back below those recent highs right there, 318-ish. Maybe some type of candlestick reversal pattern. Also watch the dollar. My outlook on the dollar hasn't changed, and we're still very much above that. Gold tends to move inversely to the dollar. This fueled the big run in gold. This sideways move in the dollar recently coincided with that sideways range. Gold broke out as if the dollar is going to break down. It's assuming that. If the dollar moves up, and I've given you targets, if it goes on to hit my second price target, that will be a net headwind for gold. A net headwind doesn't guarantee gold drops. It just means, based on the simple mathematics, that gold's priced in US dollars. A rising dollar is bearish for gold, and a falling dollar is bullish for gold. So that's it. So this breakout, again, I can easily see failing, and that's what I would bet it will do. And then when the time is right, I will engage gold, GDX, silver, all the above. So, all right, let me move on to what I wanted to cover for you, and that is my TTW list, I call it, things to watch. So I've shared this with you in the past. I'm going to rifle through these in no particular order. And what it is, it's a watch list of 40 items. They're just eclectic, random mix. Not completely random, just things that I like to watch. There's just drawing because I noticed there's kind of a downtrend line on copper. In fact, copper we have as an official trade. I haven't updated it lately because it's just been moving around here. We went long right here off the lows, somewhere in there. We hit my first target already, and we've now taken it out. Let me use these blue tools. You can see it better. And so I still maintain T2. That's the copper trade. We're up, so profitable on that. It's in my list. It's just down further. So let me go on. I just had that copper index there. All right, next index is specialty finance. These has companies like Rocket, Mr. Cooper, COOP. They're all setting up, but no actionable trade. We did trades on these before earlier in the year. If you remember, we had UMC. We hit 1, 2, 3, all 4 of my price targets. Then we put in a bullish divergent low, and the stocks rallied back to resistance. But that wasn't what I really wanted to cover today. I am. I'm going through my things I'm watching, and that's one sector I'm very much watching. And the next trade on that sector will be on the short side for me. But it's not. I don't have enough evidence right now. CarMax, I mentioned this one a couple months back on a breakout of this downtrend line. and I gave you 1, 2, 3, 4 targets. T4, in my opinion, will be hit if and only if the stock market holds up and continues into new highs, takes out the previous highs, and holds up into the end of the year, maybe beyond. Otherwise, I think this is just going to be a bear market rally. You can see longer term, the stock's just grinding around sideways for the last few years now. And ultimately an upside break. This is some super duper size, great secular bull market that's got a lot of life left in it. Yeah, I would expect an upside break. That's not what I think is going on here. So hence I think we'll get a downside break and a continuation of the bear trend that this stock has been in since it peaked back in 2021. So many stocks out there in bear markets. It's just, you're seeing fewer and fewer. The Mag 7, even less than that now, giving the market or the index as a false guise of strength. And again, that's evidenced by the deteriorating market breadth and everything else there. All right, back to my list. Again, in no particular order. I don't have these sorted by, they're not related sectors or anything. This is ITB, the home builders. I believe this one has, I believe the home builders peaked based on the technicals and fundamentals. I know they have a ton of inventory out there. They've been, fudging, not cooking the books. It's not the proper word really, but to an extent, they've been doing these huge and increasing subsidies to help clear out their inventory and buoy the prices. I've read a lot about this. You're probably aware. In other words, if you're selling a house for $500,000, but it's not moving because you have all these communities built, what do you do? Instead of dropping to $450,000, then it hurts all your other prices because that immediately resets the cost, and you take huge hit on your books because then all the prices, you have to price your other inventory down. So what they've been doing are subsidizing mortgages. They do these rate buy-ins. They lock down, give you money where they'll buy your rate down for you, whether it's for the full 30 years. In most cases, it's only a few years. And those rate locks, those rate buy-downs, many of those are starting to come due now. And so they also throw in, instead of dropping the price, they'll throw in the upgraded kitchen, give you the Silestone countertops instead of the Formica or whatever they're pushing nowadays, that kind of stuff. So just again, when I look at this chart, this is a big divergent high right there. And again, I don't know, sometimes I've told you a lot of the lines have disappeared. I'm adding them back on my PPO. There was a reset there. I don't know what happened. Lines went away. So that's it. And we already broke trend. We're below that recent high, and I don't want to spend too much time on it, but I do think that's a lot of downside in the coming year plus. AMBC, let me get back to my daily time frame. Objective short entry right now. Let me repeat that. This is an objective short entry here. We had a divergent high right here. You can see we've traded this one in the past. Looks like these are old targets. Created that back in 2023 in March. So we were right here. I would have shorted it right here off this divergent high. And we hit 1, 2, 3, 4th. And again, that line hasn't been touched, modified, moved, or it would say so right there. We hit that level, and to the penny, we reverse. This is a lot of the trades will do that, kind of call them down to the bottom, and then quite often turn around, reverse, and go long on it. But this one's came full circle. I'll put in a divergent high, just like the stock market started correct, but made a marginal new and still divergent high. Then that second and larger divergent high, you can see I'm going to add one line here. It was pointed out back then. Just simply extended this previous divergence to a larger divergence, and this stock then fell by 67%. Came full circle with that nice big divergent low right there. But right now, this is a stock in a bear market, a bear trend. That's not subjective. That's not up for debate. A downtrend is simply defined as a stock making lower lows and lower highs. If it starts to move up and takes out this high and then that high, hey, it's in an uptrend. As of now, it's in a downtrend. What do you do in a downtrend? This is simple trading 101. You short rallies into resistance. What's resistance? Both this primary downtrend line off the highs, and you got it, those magical 200-day moving averages that just work so well in a trending, not in a sideways market. You're going to go through them on a toppy sideways market, but in a strong trending market, they act as resistance when you're below them, and then support when you're above them. So there's AMBC and objective short entry. Where to? Minimum I have one support level here, about 810, then the uptrend line, but more of a continuation play. LQD, corporate bonds, just recently broke down. Worth noting, if you don't see what I'm looking at here, it's this bearish rising wedge pattern. This will be one of the I don't know what to call it, the final or first shoes to drop. The one thing that has kept this market alive, it surprised me and others, is the incredible low. And I think it's one of the biggest mispricings of risk in the market right now. Credit spreads. Credit spreads are the differential between what high quality investment grade government bonds are paying and the low quality. This is in the middle. These are investment grades. I know that. JNK and LQD are your, HYG are your junk bonds. I'll get to those in 1 second here. But investment grades have broke down. And I think this is an under-watched and talked about sector of the market, because I do know in recent years, the vast, and I'm talking vast majority issuance has been in the low triple B rated. The way that works, just to give you a quick crash course, bonds are rated AAA is the highest you can get. Very few corporations have a AAA rating. Then it goes down, AA, single A. There's different rating agencies, and they'll use a little different variations, but for the most part, they're considered anything B, and then I didn't go down B, triple B, single B. When you get down the junk bonds, when you go below the triple B rating, then you have junk bonds. They're unless they stop making payments, then they're in default. But that's different. So those are your lower rated. Now, so all these were issued right there at that triple B, just on the verge of being one notch being downgraded. And then what happens? It's a vicious cycle. So if the economy, when the economy finally starts to turn, if it starts to turn rapidly, you could see a quick downgrade. And what happens is, a lot of folks don't realize this, and we've positioned for these trades before, and I'll try to do it again. You have a sudden a domino effect, if you will, because by prospectus, you look at what the fund managers have to do, and not just LQD and your 401ks, you have investment grade bond ETFs as an option. They have to, by prospectus, jettison or sell a bond if it's no longer investment grade. So when you get a lot of those downgrades, when the economy starts to slow, the downgrades will come. Mark my words on that. It's not a if, it's a when. It's a near certainty. Just like the seasons, we're going to have recessions and economic expansions. That's the natural part of the business cycle. The Fed certainly distorted the business cycle in recent decades with excessive easy monetary policies, quantitative easing, and all that. But it will come, just like spring always follows winter. Sometimes it takes a little longer, than other times, but that's that. So we'll watch this, but there's a breakdown. I just want to point that out, that the corporate investment grade bonds have broken down. And again, I'm kind of doing this just randomly. This is what these are the things I watch, because there's just so many little facets of the financial markets, and there's always that one thing or things that tend to break first, and a lot of times they're not being watched or talked about out there. So we'll watch this. This is just one I followed to kind of get an idea on the automotive sector. This is CarMart. Again, if you roll back, that's what I'm doing here. So many stocks, big name companies peaked years ago and are clearly in bear markets. If it weren't for AI, we would be in multi-year bear market right now. But AI is what it is, and we have the mathematical weightings of the indexes, the cap weighting. All right, XHB home builders. There's the other ETF. Did I cover I already covered ITB. Need to see this trend line break right there. FedEx, it's been holding up better than UPS, but FedEx, you can see, again, another stock that has long since peaked. It's been moving lower. And recently we had this uptrend line off the lows. It broke down, gave us a sell signal, and it's been backtesting, setting up a little small minor channel below, and that just broke down. So you have a little price support here. If it breaks that, this is your next support, about 215 and change, and then probably come all the way down there about 199. It's below the 200s. I don't have an opinion. I wouldn't take a trade on this right now, but if I had to go long or short, you put a gun to my head, I would go short because we're below the 200s and we just broke that trend line, and I'd have my stop somewhat above the 200s, and again, for a bear market continuation play. Cars.com, nice divergent low. Again, a lot of the dealers, but look, rallied back to the 200s. That's probably all you're going to get. In a bull market, you got to love these divergent lows. That's usually the catalyst to move to next highs. In a bear market, positive divergences on the daily chart are usually good for, double-digit bear market rallies, and that's about all they're good for. That was about a 42% run off that divergent low. But I think most of the meat has been sheared off that bone. If not, if we can take out the 200 days, well, you see where my next resistance levels / potential targets are. But again, you look at so many other stocks, the rest of the world's in a bear market. NVIDIA doesn't. If you own NVIDIA and all your money in QQQ, you're not aware of that. But again, you look at these charts. I've covered it many times recently, my breadth indicators, percentage of stocks trading above or below their 200-day and 50-day moving averages, all that good stuff. All right, so next one up, FALN, another one to watch in the fixed income arena. Recently broke down. I'm gonna play around with these trend lines a little bit, but that's where I had it. So it looks like this one's falling down. These were this is also a tell on the market right here, and you have resistance right there. MUB, this is a national municipal bond ETF, kind of a lot like treasuries. It's, they're in a big trading range. If they break down, in other words, this is the price. These are national, so they're not state specific. They have various states in there. And if it breaks down in price, that means that yields have broken out to new multi-year, and even, just like treasuries, go back long enough, multi-decade highs. So this is it. So if we break that in price, that means yields have gone up. Remember, bond prices and yields move opposite. That has a big impact because this is, these municipalities are raising money, and that is will put added strain. It's going to be a two-pronged. If that happens, we go into a recession and rates go up instead of down like they usually do, it's going to be bad because their revenues stop coming in. Here in Florida, they get a lot of the revenues. We don't have a state income tax, but we have property taxes and sales tax and things like that. So revenues drop, and then their borrowing costs go up to finance a lot of the projects. So keep an eye on that one. Again, right now, it's kind of in no man's land. It's in that trading range. XRT, retail sector ETF. I just laid out a trade idea on that recently. We broke down. We had this bearish rising wedge at resistance. Broke down, but it's not really doing much yet. I'm going to give you right now to update. We are below the wedge, and it is still an objective short entry right now, or add-on in my opinion. Add-on really, if you took the short, I'd wait for a break of this level. Why did I pick that level? We had a reaction high right here. Several reactions right there. That's the support level. About 83. Once 83 goes, it's going to increase the odds we go down. You're going to check the 200s first. I have T1 down here at 74.19, but I will let you know that most likely chances are they're going to buy the first pullback to the 200-day moving averages. And then once the 200s go, that's usually the lights out level. You can see we had it as an official trade back here. We actually shorted it back here. We hit T1. I kept updating it, said nothing happened. We didn't go up enough to violate based on the final target, or even that third target, the RR, the risk-reward ratio. In other words, the distance to the final price targets relative to the entry point. And so then finally, just again, like the stock market, the charts were reflecting a top, saying that this thing is likely top, and it happened to break out, made a marginal new high. Everybody got bullish except me and those that stuck with this trade. And then from there, retail stocks, XRT, the sector fell 27%. It hit the bottom of my third target zone to the button. And as you know, on April 7th or 8th, whenever the market bottomed there, I posted no more covering all shorts, no more shorts, only longs, full long position. So that would be effectively, okay, don't try to hold out for T4 because we're probably not going to get there. And so now it's a new trade with new targets. And again, you have them right there. So that's what needs to break that 83-ish level, I think, to open the door, increase the odds we're going to go much lower. JNK, there's one of the junk bond ETFs. You can see just broke, but back above right now. So I want to see this level go right here. You have this nice rising wedge complete with negative divergence. And you're right up about to the previous high right there as well, right here. All right, next up on my list, AN, AutoNation. They're kind of on the car dealerships. Divergent high, hold on. Divergent high, drop, divergent high, drop, divergent low rally, divergent high, drop, divergent low rally, divergent high, drop. That's a double-digit drop, by the way. The divergence got bigger, it made a marginal new and still divergent high, bigger drop, and still another marginal new and still divergent high. In fact, it's still, when you see divergence spanning this far on the daily chart, that's when you want to, or you can draw it there. It's certainly valid. That's still, again, a successive divergent highs, really an extension of the same divergence. And you can go to your weekly chart, and like I'm just doing right now, and you can see it clearly there. And it's these big multi-year divergences that really are usually the fuel or the technical catalyst for a real bear market in this stock. I don't think without blinking it could easily go down here 55%, and quite likely, I think before all said and done, it's going to be years out, probably about a 70% drop. So maybe one day I'll revisit that, and I'll just say here, likely bear market target, and then I'll do max bear market target. Bear, and maybe in a year or two we'll revisit this when it gets there. And what's today? 9/3/25, just so we remember, although the annotations will show us there. All right, AGO. This one's a leading provider of municipal bond insurance. Okay, so remember I just talked about munis and what would happen if they break that level. It would be very, very bad. You'll see a lot of municipalities, increasing amount default, and this company is gonna have to pony up to pay the bondholders that bought those insured bonds. You can see here, I gave this to you as a trade idea back on, would have been, looks like February 27th. And looks like I gave you a total of 1, 2, 3, 4, 5 targets. But again, we covered everything due to the reasons cited at the time on April 7th, right when T4 was hit. And so and look, that's the next stop. It's, again, this was a bounce that was, in my opinion, too big and too likely to want to ride out short. So now basically this is the old T3 level, and it's acting as support again. So once we break that, T4 and then T5. UPS I already covered. It happens to be in my things to watch list because, again, UPS and FedEx are, because they are historically been tells on the market. Market access. We've had a lot of trades on this one over the years. They deal mainly in treasury, electronic trading, bond trading. So it's almost a proxy for TLT. Right now, you have big positive divergence. I want to point that out. I don't have a clean downtrend line in which this is the nearest downtrend line, and it's going to take a while to get there if it gets there. If treasuries rally, TLT rallies, then this one will most likely go up as well. And so that would be, if the trend line gets taken out, that's a potential target, 228.50 right there. PGR, Progressive, insurance companies have been weak lately. I've been watching, especially life insurance. This is property casualty, but you took out that trend line there, and you went down. This is a minor trend line that if and when broken is going to open the door to this next drop, and that's what I think will happen. We also recently, as you can see here, took out the 200-day moving averages. We recovered them right here, and we tested successfully. Buy. That's what traders, both man and machine alike, meaning the algos, program trades, they'll buy the 200s. People buy the 200s as well. When the 200s are broken, what do? You turn around and flip it in reverse. Start shorting rallies back to the 200s. So that's that. All right, but we need to break that little minor trend line to get the next drop going. Life insurance sector looking very toppy to me. You can see the chart levels. JFR, this is just one I watch. I like to watch these floating rate funds. They tend to hold. I used to, when I, my former life as a stockbroker, going back before ETFs were even a thing. We had unit investment trusts, the predecessors to that. We used to sell a lot of these floating rate funds to clients. They, you know, when the economy, everything's stable, they do well. These are what they call senior loans they hold, but they're loans. They stand below, you know, bondholders. Bondholders get paid first, then the senior loan holders, then if anything's left over, the equity holders, stockholders. And so they can kind of tell you what's going on with the economy as far as the credit markets go. So I'm watching that. It breaks that level 835. That's going to be bearish. CPER, I already told you. Trade idea, I think I already updated that. That's an active trade. MA MasterCard just cracked. I think these credit card companies are going to take it on the chin in the next bear market, which again looks like it's coming sooner than later. We had this one as a trade idea back here. T3, I guess that was hit right there. And it just broke the support. Needs to break that yellow trend line to trigger a more powerful sell signal. It moved through there a couple times. So really right now I can tell you it's on a sell signal below that trend line. Coming off a big divergent high. Auto truck dealerships, that's just a sector that has Carvana, things like that. Some of the ones I covered, CarMax, etc. And big divergent high, CarMax or Carvana going down with it, I do believe. MBI back to resistance, coming off a big divergent low. I don't have much of an opinion on that one right now. PSP, private equity. This is one I think it's obviously going to go down quite a bit. This is just my daily chart, and you got to look at the weekly chart on that and really see how big the divergence is. Coming up to big resistance, and there's your negative divergence right here to here. It's been building. So, all right, that's one I watch in my things to watch list. U.S. dollar versus the yen right here, the yen dollar pair. Primary uptrend line was broken there, but we set up this minor uptrend line. If broken, that's going to bring the dollar down against the yen. Yen rallies, dollar drops. Otherwise, if it can take back the trend line there, that's going to be bullish. Right now, I think that's the most likely. I'll watch that trend line right there. Visa, this one was an official trade. I forget where this entry was on this. But there's 1, 2, 3. Well, we've already hit my third target. I think we shorted off that, right? That break, I guess. I'm trying to remember. You can look it up. Just click under this video. You'll have all the symbol tags covered here. Click on V. It'll bring you back to all the coverage of Visa that I've had. So we need to take out that level there. And if we do, guess what, guys? Added bonus. 200-day moving averages are going to go. We've been testing the 200s. I would, if I didn't think these targets are going to be hit, then I would take them off and just say, you know what, let's just cover T3, or if you did, or I'll pull it. Sometimes I'll pull a trade even if I didn't get a perfect exit. But we hit T3, we bounced as expected, we bounced back to T1. And so once T3 goes, the 200s will also go. When we hit T3 before, we bounced right off those 200-day moving averages. So it was double support, price and 200 days. And then you have a longer term uptrend line. I'm going to tweak it a little bit because I just noticed it's not tight to the recent lows. Let me move T4 out of the way, grab that trend line. I wanted to fit the bottom of that. So it comes off the 2022 lows, comes in there at the August 2024 lows, and that's probably going to come in with T4 if it gets hit soon. We go down here, go down, hit T4, get a reaction. Then we break that trend line. That's going to open the door for even a bigger drop. And I'm going to, you know what? I'm going to do it right now. Give you T6 because I think it's going to be hit. T6. I'm going to say added in the video because next time I screenshot the charts, I won't have it here. So T6 added today. T6 added 9/3/25. Okay. Almost done, guys. KRE, regional banks. As I told you, I've recently been watching and waiting for and expecting XLF, the financial sector, to roll over. This one will roll over with it. These are just the regional banks. When the big banks go down, the regionals will as well. We already broke and back tested the trend line there. And we went up, back tested, rejected, back tested, rejected, back testing again while we're setting up in this larger wedge. We now have what we didn't have before. We haven't had since right here. Last time we had negative divergence. We shorted them back then, I believe. They dropped 32%. Now we have the first divergent high since that time, and I expect nothing less than another 32+% drop. In fact, I think we'll come down here to about 45 and change. That's going to make give us a drop about 30. And then if we enter, we start to flip some long-term trend indicators, and I have more evidence that we've started a much bigger drop. Yeah, I'll add additional targets to these regionals. Paychecks. Okay, remember today and everything I've been talking about, payroll. Look at this. Ooh, beautiful support. 135. Bam, 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 bam. Bouncing on 135 and 130. Already took out the 200-day moving averages. The job market, in my opinion, is already turned. It's not my opinion. I look at charts and I can see that it's turned. It's just the acceleration phase needs to begin. What I mean by that, unemployment drops, as I showed you, it bottoms. And unless this time is different, it doesn't stay at the record low unemployment range, 3-4%. It V bottoms. And so what happens is it starts to turn at first, just like throwing a rock into the air, almost in reverse. You throw a rock straight up, you have acceleration from the point it leaves your hand, then it immediately begins to decelerate, right, due to gravity and wind resistance. And then at the peak there, it decelerates to the point there's no acceleration. For a second there, the rock is not going up, it's not going down. Then it turns. And it starts falling slowly at first, but it builds up speed on the way down until it reaches terminal velocity. So the speed begins to accelerate. And that's the same kind of thing will happen in the job market. And then when it does, ADP and Paychecks, who are very, very much in my things to watch list. Now, look, Paychecks already broke that primary trend line. It already broke the 200s. This is an objective short entry here right now. However, I'm sorry. It is or will be when it clearly takes out this 135 support. And I'll give you, I can just point to these levels right here. You can see my targets right now. Any or all of these levels. All right, ADP is right next to it. There's ADP. ADP also is very close. So you can see there's my primary uptrend line, comes off the COVID lows right here. What happened? Unprecedented stimulus, both in the US, around the world, both monetary and fiscal stimulus. Nothing to the likes of which has ever been seen. So, the job market went zero. The economy shut down. So ADP went there. And this is all that COVID stimulus kind of working its way out. And now you can see this one is just starting to lose the 200-day moving averages. And again, this is a big one to watch. It's a tell on the economy. We had a brief drop there, but stated at the time, it was overblown, overdone, time to cover those shorts that we made on there. And so we briefly went there, and one day it was over. We went down one day, took it back the next day. So that was a successful test of the 200s. It was, yes, a brief violation. That's not unusual to see stocks briefly violate or move above or below but you can see in a bull trend, bullish, the stock, they buy pullbacks to the 200. They bought pullbacks. They tested it again, been testing. Oops, broken today, first day. And we're going to print a solid close today below. However, again, this is what my BOD level or benefit of the doubt is, this uptrend line. And right here, this is a big one too, about 286. I see some support there. And so a lot of juice on this one. When you look at the weekly chart, you can see the big divergence right here. A lot of downside on that one potential. IAI broker dealer index, big divergent high right here, needs to take out 167.73, and that will trigger a drop down to the 200 days, 153. You can see all these potential targets there. JPM, the 800-pound gorilla in the financial sector, right there. Bearish rising wedge, negative divergence, needs to break that trend line, and that will trigger a sell signal. And then this is your BOD, or benefit of the doubt level. Once that 280 goes, then it should be lights out. Then it goes, tests the 200. They're going to step in and buy the 200s on the first pullback, most likely. That comes in with that 262-ish price support. And then once that goes, bigger things are happening with JP Morgan and the banking sector. So that's what to watch for on that one. MCO Moody's. This is a big one right here. And Moody's has triggered a nice sell signal. Beautiful bearish rising wedge, complete with negative divergence, breakdown, sell signal, objective short entry. This was an ascending broadening wedge, aka megaphone, or just a broadening wedge, not an ascending, a regular broadening wedge, aka megaphone pattern, broke down there. And now you have this rising wedge pattern right there. KCE, that's capital markets, the likes of Morgan Stanley, Goldman Sachs, Schwab, BlackRock, S&P Global, KKR, ICE, CME, Robinhood. Those are some of the ones in this ETF right here. Nice sell signal. This is an objective short entry as I speak. Next sell signal, or all in. I wouldn't go all in because that's the BOD level. Big level there, 148. Why is it big? Well, that was all-time high. Tested it again, got rejected, had a breakout. This is all a breakout to new highs. On face value, that's bullish. However, if that fails, which my expectation is, that's going to be very bearish because that's a failed breakout. And that's going to take you down here to 139.90. We'll call that 140. And the 200 days, they're going to buy the 200s. You want to cover there, bounce it, and then that'll go, I think, and then we're going a whole lot lower on this one, in my opinion. CAT, Caterpillar, same thing. There's a lot of breakouts to new highs recently. Everybody's gotten giddy. AI is going to take the whole world up with it. But what I see here is that just nice setups. That's why I'm going through these stocks. There's so many of these right on the verge of breaking really nice support, or other ones that have just broken down. So we just need to see the rest of the lot. When I go through this list, whether it's a week or 6-8 months from now, and the majority of these have broken down, then the market's in trouble. Right now, majority are on the verge of breaking down, but the majority haven't yet broken down. TIPT, Tiptree, financial, divergent high. There's your uptrend line. You need to break this trend line, then it'll offer an objective short entry there. SOX, semiconductor sector ETF, also an active trade out right now on the site with these targets here. Big divergent high, DH1, wedge break, been floundering around, needs to clearly take out the S1 zone, which I still believe it will do. But until it does, it's not going to go much lower. Then it'll hit T2. They're going to come in. The 200-day moving averages come in here as well. Once that goes, then it opens the door to these deeper targets I have there. Carvana, as I mentioned, also likely to buckle with the market. And just big divergence, been building. I gave you long-term targets on Carvana back here off this previous divergent high right there. We hit the first target. We hit it at the time I said cover all shorts, go full long, early April right there. And so it's not mere coincidence. That's where the reaction came from. It was the first target. As expected, a reaction. It's been a pretty good one. And following this divergent high, bigger divergence leads to a bigger drop. Should take us down to T2, T3, and then that potential T4, which I'll most likely, if we get down to T2 and T3, depending on what the market's doing, I'll most likely make that the official final target. That would give a potential drop of 84% in Carvana. If we get down to T3, it's going to be about, from where we're at today, about 73%. You can see that would have been when we first shorted it. If it hits T3 from where that initial short was, that would have been a 65% drop. But again, there were all the reasons in the world to cover shorts there and go long. So it's really kind of a new trade, if you will. And then last but not least, TNX, as you know, the 10-year treasury, or 30-year, no, 10-year treasury yield right here. This is a recent consolidation area. If it breaks out, we're going to go up to multi-year highs in the 10-year yield, and that's going to be bearish for the market. Okay, we are exactly at the 1 hour mark. Remember, you can always hit the fast forward button or the increase the playback speed on any YouTube video, including this one. Bottom lower right hand corner, there's a settings icon. Click on that. Increase the speed to 1.5, 1.75, whatever you want. You can always slow it back down, and that'll get you through these quicker. So I'm going to wrap up here. This has been Randy Finney with Right Side of the Chart.